Well, I want to think about this notions of cash flow. And to do that, I'll look briefly at the income statement. So the income statement is over here on the right-hand side, and it starts with revenues. And I have product sales in this case, and consulting income, and fees, and leasing, etc. And each one of these items, each one of these lines is a revenue line. Well, great. It tells us something. I'm not sure that it tells us everything, but it tells us something. But I think we need to consider, how is it that I can say that revenues are sales? Well, product sales, that's easy, right? So, you walk in and you buy a product and there's somebody sold it to you. How is it that consulting income can be considered sales? Any idea? Well, let's see. Lisa, you look like you're a consultant now, right? You are now, right? You can nod your head.
Okay.
Okay. So as a consultant, you don't sell a tangible product, do you?
No.
What do you sell?
A way of operating a business or running a business, maybe procedures.
Okay. So something that you used your time for, right?
Correct.
I will tell you that a consultant, as well as any other service provider, sells their time and the talent. Okay, so consulting income is we've sold it. The income is what we get for having sold the use of our time and talent for that period of time. Subscriptions and fees or royalties. We have sold to some other party the use of some of our developed resources. Equipment leasing. We've sold to someone else the use of our equipment for a period of time. Incomes for private equity or interest incomes. We've sold the use of some of our money. So we're going to normalize very often, and we're going to treat revenues and the term sales as though they're synonymous terms. And to most financiers, they are. Okay? Revenues means sales. And each one of these items that I have here, from product sales all the way down to private equity incomes, we can think of all those as having sold something. It's important as we work through this course. Well, the next category that we're looking at then, of course, after we have our total income or our total revenue, is operating expenses. And so we've got a variety of types of operating expenses. And some income statements are very simple. There might just be one or two categories. Some income statements are extraordinarily complex, but operating expenses tend to be separated out from revenue, of course, and they tend to be separated out from non-operating expenses. So in this case, as we're thinking about notions of cash flow, and one of you used revenue, as we were talking earlier, well, revenue clearly is one of the notions. It's an input. But revenue minus operating expenses is our operating income. And operating income is also called EBIT, earnings before interest and tax. EBIT, earnings before interest and tax. It is operating income. Well, one of the expenses in our operating expense category is depreciation. And I'm terribly sorry. I'm trying to remember your name. It's the UTBS. Will you come off of mute for a moment? Thank you. Remind me your name, please.
Bella.
Bella, thank you. So Bella, do you suppose a company ever cuts a check for depreciation?
At times, yeah.
Okay. And I will tell you that depreciation is expensed on the income statement, but the check that we cut for it was when we actually bought the asset. Depreciation is called a non-cash expense. So over time, it's the recognition of the depletion in value or obsolescence or wear and tear. And the check that we cut was when we actually bought the asset. When we put it on the income statement, we're technically transferring value from the balance sheet to the income statement. And we're recognizing that this asset we used in producing the cash flow is being used up over time. And so that's what depreciation is. It's a non-cash expense. In most cases, you're not ever going to write another check for depreciation. In fact, the first one, you weren't even thinking about it having written it as depreciation. You wrote it to buy the asset. But Bella's right. You kind of used that as all of the future depreciation that you might have from this deal. It's a non-cash expense. So as we go further in this cash flow funnel, if you will, we're going to back depreciation out. In fact, it's the next thing that we do. Oh, excuse me, let's go here. We go from earnings before interest and tax, or operating income, down to EBITDA, or earnings before interest, tax, depreciation, and amortization. What is amortization? Kate, do you know what amortization refers to in this context? And anybody, anytime I ask a question like this, anyone is certainly pleased to jump in and help answer. Do you know amortization in this context, Kate?
I don't.
It's okay. Does anybody else?
So you think of amortization as an amortization schedule. That's all that comes to mind for me, Rick.
Well, that's what comes to mind for most of us, like on our mortgage, right? The amortization schedule, the amount of principal and interest. Well, in this part of finance, it's not what it means. Amortization is the depletion of value of a non-tangible asset, whereas depreciation is a depletion of value of a tangible asset. So amortization is just depreciation of a non-tangible asset, like a patent or like having some goodwill on a balance sheet. So something we can't put our hands on, but it's something we can't ignore because we're using it to help create our cash flow as well. So I will generalize most of the time. And when I refer to depreciation, I'm always referring to depreciation and amortization. It's going to be very unusual in our class for me to give you an example that has amortization. Typically, it's only depreciation, but know that they fit in the same category. They are non-cash expenses that are part of our operating expense. And remember, they show up down here in the operating expenses. They're part of our operating expense, and we account for them before operating income or EBIT. Okay? Well, as we go from EBIT, and then we go to EBITDA, which is adding back the depreciation, so it's going to be actually a bigger number than EBIT, we can then move to something called NOPLAT. And if any of you know what NOPLAT stands for, I'll be impressed and bewildered. Do any of you know NOPLAT? No, I was hoping somebody might get me. So NOPLAT stands for net operating profit less adjusted taxes. Net operating profit less adjusted taxes. And its calculation is EBIT times 1 minus the tax rate on EBIT. We're going to come back in a few moments and discuss this tax rate on EBIT issue, but the equation is EBIT times 1 minus the tax rate. NOPAT is a little bit different than NOPLAT. Net operating profit after tax. And that's going to equal EBIT minus the taxes paid. So let's go back over here to the income statement for a minute and take a look at something. So in this case, I will tell you that for 2019, we have a flat corporate income tax schedule at the state and the federal level. The corporate income tax schedule at the federal level is 21%, and it has been that way since January 1st of 2018, and it will be that way until it changes. At the state level, it's approximately 5%. In Utah, it's 4.95%. We're usually going to generalize and say that states have a 5% income tax rate. And again, for businesses, it's a flat tax. So together, that's a 26% tax. And in 2019, regardless of what the dollar value was, the tax rate was 26% when we take state and federal, add them together. So let's look at our taxable income for a minute. We go from operating income, or EBIT, and then we can subtract out our non-operating expenses like interest or some expenses that came from something other than our operation, and we get to what's called taxable income. Well, if I want to take this NOPAT, I would say EBIT, so 51.063, minus taxes paid of 12.793. So EBIT minus taxes paid is NOPAT, net operating profit after tax. So let's just calculate that real quick. I've got 51.063 minus 12.793, and that number is 38.27. Remember that for just a moment, if you would. 38.27. And I took the 51.063 and subtracted 12.793 to get there. Okay? That's no PAT. Well, what is no PLAT? Would it be the same number? Maybe. My guess is maybe not. So I'll take 51.063 and I'm going to multiply it by 1 minus 0.26. And 1 minus 0.26 is 0.74, right? So 51.063 times 0.74, that equals 37.786. I'm going to store that number. Well, what was the original number for no PAT? It was 38.27. No PLAT is 37.78. How do we get that difference? Well, Diana, I'll use you for just a moment if you'll come off of mute. Do people and companies always pay the tax rate applied that would be a function of their taxable income? Do they take and apply that to their taxable income, come up with the taxes paid, and is that the amount of tax we always pay? Or do we sometimes pay a different amount in tax?
We sometimes pay different amount of tax.
Yeah, good answer. I like that. And you say that with absolutely no confidence, but because you knew that's where I was leading you. So you have earned the Tesla. You happen to be one of the senior vice presidents in my company. And when I bought that Tesla for you, I didn't need to buy it. It was not an operating expense. I could have just as easily bought you a Mercedes, right? But when I bought that Tesla, what came along with it? Does anybody know?
Tax?
The rebate.
A
Oh,
$7,500 tax credit at the federal
Tax
level.
credit, yes.
So the taxes we might pay may not be exclusively a function of the tax rate applied to the taxable income. So we're going to think about metrics that lead us to evaluation that have nothing to do with discretionary choices on the part of management. I could have just as easily bought her a Mercedes or a Volkswagen or told her to go get on the moped, right? But I decided to buy a Tesla because I kind of dig them, to be honest with you. And if you could see my office, there's pictures and models of cars all over my office. I'm a kind of a car guy. The tax rate on EBIT may have nothing to do with the actual tax we pay. The tax we pay is a function of tax rates and other decisions. So when we think about this issue of no PAT or no PLAT, we have to think about it from the standpoint of taxes paid versus a standpoint of some theoretical tax that would have been paid absent those other discretionary choices like buying your Tesla, or maybe having some loss carry forward from a prior year, or maybe having moved my business from Salt Lake County down to Juab County and having received a really good tax credit from Juab County in the state of Utah for doing it. Or maybe I put solar panels on the roof of our warehouse and got a really good tax credit for that.
Hey, Rick.
Yeah.
So I just so I understand this, I just want to state it back to you to clarify my understanding, because this is actually one of the things I wrote down from reviewing some of the materials this week. So if I understand, I think that explanation actually helps me understand these two different concepts of no PLAT and no PAT. If I just to rephrase it, so no PLAT is based on what the tax rate is, and it's something you could use maybe to project, use as a number to project, decision making, versus no PAT is, what is the practical use of it, right? So the taxes paid, that's after, like you use the Tesla example, that's like after your tax credits or your deductions or whatever the case is. I mean, that's simply the difference, right?
You're exactly right, Matt. And the taxes I paid might be a function of other decisions that had nothing to do with the operation. Maybe my operation is manufacturing skis and snowboards, right? And the fact that I happen to have purchased a villa in the Bahamas for all of us senior vice presidents to share when we can go down there, that's nice, and it's a deductible expense, but it's not a function of my operation. We make skis and snowboards, for heaven's sakes. Well, I go ahead and buy the island of the villa in the Bahamas because we're going to enjoy it and because I get a tax break in doing it. Okay, so we're going to try to divorce from any of our metrics the influence of discretionary, non-operational decisions because we're thinking about the value of assets. And I have to think about this asset, whether Shenzhen's owning and managing the company or whether Kylie's owning and managing the company. So I have to strip it back to a point where it has nothing to do with their discretionary choices, has only to do with their required choices and their operational decisions that are a function of efficiently running the operation. Does that make sense? This is going to be a little counterintuitive sometimes, and I apologize for that, but try to continue to think about that. We're going to morph some of these inputs to a point where you can't see reflected in them discretionary choices. Because if I'm looking at the asset and Mario's looking at the asset and Andrew's looking at the asset, and we're all three trying to estimate its value, we should come up with the same value because it has a value. Mario might do it differently. He might buy the Teslas. Andrew, I know what Andrew's going to do. He's taking us on our corporate retreat to Rome. Oh, forget Rome. We're going to Tuscany, brother. And we're going to eat well, right? Okay, but I'm putting solar panels on the roof, or who knows what it is. We can't include those. So kind of keep that in the back of your mind. Well, obviously, I just walked you through taxable income. It's EBIT minus non-operating expenses. Again, we can see it here. EBIT, 51.063, minus the taxes paid. That's the only non-operating expense. EBIT minus the interest, which is a non-operating expense. It's the only non-operating expense we have. But why is it that interest paid, that's interest paid on our debts that we are contractually obligated to, how is interest not an operating expense?
Because it's a product of financing, not actual operations.
Well, okay, but I couldn't have bought the company if I couldn't run the company without having floated those bonds and having that mortgage. I didn't have the money in my pocket, did I, Matt?
No.
Okay, so why is it a non-operating expense? Well, Carol, you look rather wealthy to me tonight. We're going to hope for your sake that you are. And you were interested in Mira Dravana, and so was I. I happen to have been the one that bought it, though, okay? When you were looking at buying it, you could have simply transferred money with your debit card from your account to the company's account, the former owners of Mira Dravana, and you could just paid cash and had no debt, right? Because you're wealthy tonight. I, on the other hand, I didn't have that much money sitting around. So I put some money into it, my own cash, but I had to borrow the rest. Is that an operational decision, or is that a discretionary choice on the part of management and the stakeholders?
Discretionary.
Yeah, right. Now, I would say maybe it wasn't that discretionary for me because I didn't have the money, but the fact of the matter is I didn't have to buy the business. It's discretionary. So interest expense is a non-operating expense. And Matt, you're right. It stems from the finance relationship. It's the way that we chose to capitalize it, okay? Well, it takes us down to taxable income, and we know that taxable income minus taxes is net income. Interestingly enough, we will rarely talk about taxable income beyond this tonight, and we will not use net income for anything but the simplest of our finance metrics. We will not use net income in our valuation at all because net income is tainted by taxes paid and by interest expense, both of which are a function of discretionary choices, or at least influenced by discretionary choices. So we're stripping this back to EBIT, and then we're doing some things with EBIT. Well, let's look at a couple of numbers here that are from what we were just talking about, and you can see this, and I don't want to take too much time here. We looked at what EBIT was. It was the total revenues minus the operating expense, so 273.64 minus 222.577, taking us to that 51.063. We looked at EBITDA, and we just said it was EBIT plus the depreciation. Again, depreciation is always going to be for the same year. In this case, it was 3.89. And that then brought us to EBITDA at 54.95. EBITDA will always be greater than EBIT unless depreciation is 0, in which case it's equal to EBIT, right? EBITDA cannot be less than EBIT. For it to be less than EBIT, it means depreciation is negative, and depreciation cannot be negative. It defies GAAP and FASB principles. Well, no plat. I've taken this 51.063 and I've multiplied it by 1 minus the tax rate, or in this case 0.74, which is 1 minus 0.26, and it gave me the 37.78. I can look at no pat with 38.27. We walked through that a little bit ago. And then you already saw on the income statement that my taxable income was 49.02 and my net income is 36.41. We will rarely ever venture back into this category except for in some of our finance metrics. We'll never do so in our valuation construction. We'll use it above this line and predominantly EBIT, bringing back into it the depreciation, and then we'll do a few other things as well. I'm looking for cash flow, right? And the reason we're going to take EBIT and add depreciation back in is because depreciation is a non-cash expense. So I didn't actually spend depreciation. So to get this from EBIT to something more cash flow-like, I have to move it to EBITDA. I need to add depreciation back in. Any questions about that yet? So here's one of the things I know about this at this point. Everything I'm saying, you understand. Every little jot and tittle, right? And you don't have a freaking clue as to what I'm talking about. Is that right? It's okay, honestly. In fact, let me tell you about an experience I had when I was doing my doctoral work. So I was a little bit older than I think all of you when I did my doctoral work. I started into that program when I think I was 52 years old, about 10 years ago now. And there was this sweet little Romanian woman who became one of my best friends. She's just a dear friend now, and her name is Kadrina, and Kadrina taught my econometrics course, which is all about statistical regression, and I didn't understand what she was talking about. And I would go from her classes at night, and I would go, and I'm a fairly, I'm not an overly emotional guy. Okay, I'm a capitalist, I'm an investor, and I would go from her class and I would go sit in my car and I would cry before I would go home because I understood every word Kadrina was saying and I didn't have a clue as to what she was talking about. Every week for about 7 weeks out of a 17-week semester. And at about week 8, all of these little disparate parts that had been being thrown at me like shotgun pellets started to look like a pattern and a system. And all of a sudden I realized they weren't disparate parts. They were a system. Well, for you, you might be going through some of that exact same experience right now. And we got all these little things floating around. And in about 3 weeks, they will start to congeal for you by week 3 or 4 of the course. And all of a sudden, you're going to realize that you know what we're talking about. In fact, you can speak the same language, not just have all the little points of memorization. So believe me when I tell you that you're going to get there. Well, I've gone through and worked out some of these numbers for you for the various notions of cash flow. I now want to think about taxes for a moment. Prior to January 1st of 2018, at the federal corporate tax level, we were on a graduated tax scale. That meant the lowest level of income at the federal corporate tax was taxed at 15%. The highest was taxed at 38%. On top of that was a 5% state tax. So we could have been anywhere from 19%, or rather 20% at the bottom, state and federal combined, all the way up to 43% state and federal combined at the top end. It was a graduated structure. We went from that at the end on January 1st, 2018, we adopted the federal flat tax schedule that we have now. That little quotation mark doesn't belong there. I apologize. I think it was supposed to be an equal sign. And we add to that 5%. So we're now at a 26%. We don't have a graduated schedule any longer. Let me bring up a spreadsheet that you have access to, and I thought I had already pulled it up. Please excuse me. And I'm going to bring up that federal income tax calculator for a moment. So bear with me as I do that.
Hey, Rick, while you're pulling that up, just to
Please.
clarify, I know you sent that to us in the WhatsApp, but I assume that's out on Canvas as well.
It is. It's
Okay.
under this week in Canvas, and it's on that website as well. So you see, I'm just looking through my file structure to find it. Here we go. So this is something I put together for you guys a couple of years ago. And the way this works is we have the graduation levels of income, and then we have the tax rates at that income level. And then based upon the amount of earnings we're putting into this system, it'll tell us how much tax we owe and what the average rate is. So this one is for pre-2018. You can tell by my tab. So if I've told it we've got a 4.95% state rate because that's always flat. I've said that in this case we've got a subject income of $7.98 million. Let me change that to $3,500,000. So we change it here. So $3,500,000, and notice that the amount of tax went down, of course. And the tax rate stayed about the same because the average rate, now that we're at such high income levels, is going to stay at that rate. Well, so this is how you might identify the tax rate for the tax rate on EBIT or the taxable income if we're dealing with 2018, or rather before 2018. So we're dealing with 2017 and before. However, some of our problem sets and some of our cases we'll deal with after January 1st, 2018. So this next tab is the exact same thing, but it's with that flat tax at the federal level added to the flat tax at the state. So I put the same $3,500,000. You'll notice I pay a much different tax amount. Over here on the same $3,500,000, I'm paying $1,363,000. Here, after the Tax Act, I'm paying $908,000. I'm going from a 38.95% tax bracket down to a 26.95% tax bracket. That's the effect of the tax regulations that went into effect January 1st, 2018. You have this because for two reasons. One is some of the casework that we'll do will be from before January 1st, 2018. But also, our economy has seen a flat tax schedule 5 or 6 times in the last 100 plus years. Every time an administration goes into office that wants to simplify the tax structure, they put in a flat tax regime. It sticks around for a couple of years until somebody wants to tinker with it. And inside of a few years, maybe 4, 5, 6 years, we're back to a graduated structure. So I've given you both of these because I'm certain that at some point in the future, we'll go back to a graduated structure, and you guys will have a tool that will let you articulate it and let you manipulate it at the time. So I've given this to you that accommodates both, okay? Well, let me go back to the tax rates. You'll see the tax rates from January 1st, 2018, the tax rates after December 31st, 2017. But I'm telling you that in addition to thinking of them by date, we're going to think of them as having 3 separate and distinct kind of tax rates. The first is the tax rate on EBIT. The second is the tax rate on taxable income. That's what that TI stands for, the tax rate on taxable income. And the last is tax rates being a function of taxes paid. Tax rate on EBIT and tax rate on taxable income in a flat regime will be the same rate. They're both 26%. But if we were back in our graduated structure, they wouldn't be the same rate. In fact, in this case, if our company had $3.5 million in EBIT, well, under one regime, it's 26%. On the other regime, it's 39%. Okay? Graduated versus not. So I have to think about that sometimes. So when I'm wanting to know the tax rate on EBIT, I will put in the amount of EBIT in my box here, in my input screen, and it'll tell me the amount of taxes that it should be due and the tax rate. But this is before any special deals, right? This is before any discretionary choices. This is the tax that we should have to pay. May not be the tax that we actually pay. So that would be how we think about the tax rate on EBIT, tax rate on taxable income. And we already talked about the fact that the taxes we pay may not be exclusively a function of a tax rate. They may be the result of something else. So that's going to come up with yet a different number. So we've got 3 different tax rates that we may have to think about. Normally, we're going to use the tax rate on EBIT. Every once in a while, it'll be the tax rate on taxable income.
So just to clarify, Rick, so it sounds like, not to keep simplifying things too much, but it's just easy for my brain to process.
Matt, everybody else is saying thank you when you ask a simplifying question.
So, I mean, it sounds like basically with that calculator you got, the difference between those versions, as you put it, is just simply based on the input, because the input is going to determine a different rate, which is going to determine a different taxable amount.
Well, in this case, Matt, it's based on 2 things. It's based on time, so January 1st, 2018, before and
Right.
after, okay? But then it's based upon amount. So if we're looking at this from after January 31st, or January 1st, then a $3,500,000 EBIT is going to have a 26% rate. So is a $15 million, because it's a flat rate. It doesn't change, right? So the amount of tax changed, but the rate did not. And we're more often than not going to use a rate because we're going to apply it as a rate. But had this been before January 1st of 2018, notice that our tax rate on $3.5 million is 38.95%, but our tax rate on $15 million is 39.28%. So whereas it didn't change after January 1st, depending upon the input amount, it does change before that. And some of the cases that we'll look at will be from before and some will be from after. So you just be paying attention, and you have the calculator that will allow you to calculate either one.
Right, but and that all makes sense. But I guess just to clarify on the slide, so the only difference would be there you put in EBIT, whereas you might put in taxable income is a different version. Like that's when you see there's 3 different versions on the slide. Like I get what you're saying about you've got graduated versus flat, so you have to take that into account based on the timing. But the versions are also based on, you know, what input you're putting in there. Are you determining the tax rate on EBIT, or are you determining on taxable income, or whatever the last one was?
So let's look at the Mira-Dravana case for just a moment for that. Here we have Mira-Dravana, and we've got 51.063 million, so 51,006,300. Okay, and is that right? Yeah, and we have taxable income 49.204. Okay, let's put those into this tax calculator, but we're going to put them in millions because that's what they are. So 51, and this will be pre January 1st, 2018. 51,063, and that's million. So it gives us a 39.95% rate. 51,063,000. As opposed to, what was the other number? It was 49,204. So putting that into the calculator instead, so this would have been our EBIT, which would have had a tax rate on EBIT of 39.95%. But with taxable income, 49,204, well, it happens to be the same amount because it's such a big number, okay? You would see that it is actually different if we extend this out a long way. Notice that number.
But you can see the tax amount itself changed, right?
The tax amount changes.
Obviously, based on the number, you know, it's like a slight difference, but I think that answers my questions. I just wanted to confirm that that was in fact the notable difference between those 3 versions.
You're exactly right. So time and amount, when it took place and amount is what we're looking at here.